Robinhood says trading is free and democratic for everyone. You might feel a rush of relief when you see zero commissions listed, but the truth hides behind that comforting zero. When you tap to buy a stock, you assume the platform works for you and not against you. What happened next will shock you about how that simplicity was designed to extract profit from your trades. In 2013, two young founders promised to democratize finance and remove fees that locked people out of markets. You could finally trade without paying a commission, and that promise spread like wildfire across retail investors. The move forced an industry-wide revolution that rewired brokerage economics almost overnight. But when an entire industry scraps commissions, something else has to replace that lost revenue, and you should be curious about what fills the gap. Robinhood's pitch was simple, clean, and emotionally resonant for a new generation of traders. You were sold on access, on ease, and on a narrative that said the old gatekeepers were over. But here is where it gets interesting, because free services rarely stay free without a hidden exchange of value. To understand that exchange, you have to follow the orders leaving your phone and trace where they go next. Every time you buy or sell a stock, your broker has to route that order somewhere to be executed. You might imagine the exchange is the only destination, but brokers routinely send orders elsewhere before they hit the open market. This routing is ordinary for brokers, but what changed is who pays for those orders and why it matters to you. That change is the technical core of payment for order flow, which deserves your full attention. Payment for order flow, or PFF, sounds like dry financial jargon until you realize it determines the price you actually get. You are not just paying commissions, you are paying through worse execution prices when middlemen profit from your trades. PFF means someone pays your broker to handle your order before it hits the public exchange. And the incentive structure changes the calculus of what a broker considers important. At this point, you should ask who benefits when your orders become a commodity. Citadel Securities and a few large market makers pay billions to brokers for retail order flow. You need to understand that this is not charity. It is a calculated business arrangement designed to funnel profits to large trading firms. When Citadel pays Robinhood, those payments become a major revenue line that replaces commission income. That shift is what allowed commission-free trading to scale rapidly, but it also introduced deep conflicts of interest into the retail trading ecosystem. At first glance, the system seems efficient because market makers claim they give better prices in return for being fed retail orders. You might assume that your order goes to the place that gives you the best price, but reality is more complicated and less benevolent. Market makers often profit from internalizing trades and collecting the spread between buy and sell prices. And your trade becomes a predictable source of revenue. When profit incentive outweighs best execution, you become the product rather than the customer. You might wonder how much this actually costs you because you see no commission on your statement. The cost is hidden in the execution price, in the tiny differences between the price you see and the price you actually get filled at. Those differences pile up into real money when multiplied by millions of trades and frequent retail activity. What seems trivial for a single trade becomes billions in revenue for the firms receiving those orders. Studies and internal data have shown that retail investors often receive worse execution prices on PFO arrangements than they would on public exchanges. You must remember that the best displayed price is not always the executed price, and that gap benefits market makers. The aggregate effect means you are subsidizing the infrastructure that makes high-frequency trading profitable. That unequal distribution of gains is the central irony of the commission-free revolution. Robinhood reported making roughly $2 to $3 billion annually from payment for order flow at the height of retail trading mania. You should sit with that number because it reframes what free trading really meant for the company. Those billions funded quick growth, marketing, and an aggressive drive to add more retail accounts. But that revenue came with regulatory attention and scrutiny that would eventually explode into headlines. In 2020 and 2021, retail trading surged during volatile markets, and Robinhood's user base exploded as new traders poured in. You were part of a demographic shift that changed trading from a specialized activity into a mass market pastime. This influx made retail orders extremely valuable to market makers who could process them profitably. When volatility spikes, the spread widens and profits can be immense for those who control order flow. What happened next will shock you, because the opaque incentives collided with a market frenzy and a few big players. The GameStop saga in early 2021 exposed the fragility and conflicts baked into platforms that relied heavily on payment for order flow. When trading volume exploded, Robinhood made millions from increased order flow while simultaneously facing limits on liquidity and capital constraints. The decisions the company made under pressure highlighted uncomfortable truths about who they serve when markets get chaotic. During the GameStop short squeeze, Robinhood temporarily restricted buying on certain volatile securities, a decision that outraged millions of users. You probably remember the anger and disbelief when an app that promised democratization appeared to shut doors for retail investors. The move revealed that the platform's obligations under capital rules and its relationships with clearing firms and market makers can limit user access when it matters most. That moment crystallized the conflict between retail customer experience and institutional dependencies. The Securities and Exchange Commission began looking closely at these practices, and scrutiny intensified across Capitol Hill and financial media. You should understand that regulators are concerned because PF-off can create misaligned incentives between brokers and their clients. In late 2020 and early 2021, the CSE and other authorities initiated reviews into whether payment for order flow undermines best execution. That regulatory pressure was not just a PR problem. It questioned the legal and ethical foundation of a widespread business model. In 2021, Robinhood agreed to reforms and disclosed practices, but also faced enforcement actions that culminated in fines. You need to know that the Securities and Exchange Commission fined Robinhood $65 million for misleading customers about revenue sources and execution quality. That fine was both a punishment and a public statement that transparency around PFF matters, but fines alone do not necessarily realign incentives, and you should ask whether disclosure is enough to protect retail investors. Beyond fines, the crisis forced a conversation about whether brokerages that profit from more trading will gamify user experience to encourage activity. You should be skeptical when an app designs features that nudge you to trade more frequently for its revenue benefit. Robinhood's gamified interface, confetti animations, and simplified language made trading feel like a game and masked the real financial consequences. When engagement becomes profit, the line between service and exploitation grows disturbingly thin. Europe reacted differently to these conflicts by limiting or banning payment for order flow in certain jurisdictions. You should pay attention to that regulatory divergence because it offers an important comparative experiment in investor protection. The European approach prioritized transparent execution and anti-conflict measures, effectively stating that the route of making money by steering orders can undermine market fairness. If the EU deems something too conflicted, that raises questions about why the US tolerates it. So how do these arrangements translate into dollars out of your pocket over time, especially if you trade frequently or use market orders often? You might not notice a few cents here and there, but over hundreds of trades those cents compound into hundreds or thousands lost. The math is simple when scaled across millions of retail accounts and countless daily transactions. Understanding that math changes how you think about the true cost of free trading services. If you want better execution, you can use limit orders instead of market orders to control price and reduce the chance of slipping into a worse fill. You should become familiar with different order types because they are the simplest tools to reclaim control of your trades. Alternatively, consider brokers that route orders directly to exchanges and publish execution quality metrics transparently. Being proactive about order types and broker selection directly improves the quality of your trading outcomes. You can also compare execution statistics published by brokers, looking for better price improvement and lower effective spreads across your typical trades. You should compare apples to apples by considering not just commission costs, but price improvement and effective spread numbers. Some brokers publish monthly execution reports that reveal how often they improve upon quoted prices. Digging into those reports gives you real evidence about whether your broker truly acts in your best interests. Another practical step is to limit frequent trading and avoid impulsive trades driven by in-app gamification or social media hype. You should ask yourself whether a trade is genuine investment or an emotional response amplified by app design. Reducing churn in your account decreases the slices of execution costs you surrender to market makers. Disciplined, slower investing reduces the chance that you will be exploited by volume-driven incentives. The central ethical problem is simple. When your broker's revenue rises with your trading, incentives can misalign in ways that harm you. You should be cautious when companies monetize your attention and action rather than providing pure execution quality. Robust fiduciary duty, transparent disclosures, and healthier business models would align brokerage incentives with client outcomes. The debate about PF-off is fundamentally about whether the current structures can ever truly serve ordinary investors. There are plausible reforms that would reduce the conflicts inherent in payment for order flow, including stricter disclosure rules and quality of execution mandates. You should support reforms that require brokers to prove they are delivering the best prices, not just selling order flow to the highest bidder. Another option is banning PF-off or regulating it in a way that prevents extraction of retail order profits. The policy conversation is alive because the costs of inaction fall unevenly on less sophisticated investors. For individual investors, the takeaway is wearable and actionable. Nothing truly free comes without trade-offs. You need to educate yourself about order types, scrutinize execution reports, and choose brokers that align with your priorities for price and transparency. The platform that feels free can still be expensive in slow, invisible ways that compound over time. If you accept that reality now, you can make smarter decisions that preserve your capital and dignity as an investor. Robinhood changed markets and introduced innovation that lowered explicit costs for millions of new investors. You should acknowledge the value of democratizing access while remaining critical of the ways commercialization can undermine fairness. The company's success exposed systemic vulnerabilities in market structure that affect everyone who trades. That dual truth is essential to understanding the modern retail investing landscape. The GameStop drama and the SEC fine were wake-up calls that revealed specific harms and opaque incentives. You should view those events not as isolated scandals, but as signals of deeper structural misalignments across retail finance. If regulators, brokers, and market makers do not change how they balance profit and client outcomes, the next crisis will expose further cracks. Understanding the stakes puts you in a better position to demand reforms and protect your money. Remember that you have practical power as a consumer to reduce the hidden costs you pay. You should use limit orders, check execution reports, avoid impulsive trades, and consider brokers focused on transparent routing practices. Those changes are small behaviors that meaningfully change your financial outcomes over years. When millions of users make smarter choices together, market incentives follow suit and become less extractive. The final philosophical twist is that the word free obscures responsibility, and you are the only person who can demand both affordability and fairness. You should treat every free service as a negotiated trade and ask whose interests are being served by each invisible dollar. If this gave you a new perspective on how fintech really makes money, then your next trade should be an informed choice rather than a reflexive tap. If this gave you a new perspective, hit subscribe and join the conversation about how to make markets work for everyone. Outro and final invitation to viewers to act and share this knowledge widely with friends and family. You should encourage others to question simple promises and prioritize transparency when choosing financial services. The fight for fair markets is ongoing, and your attention makes a difference. So subscribe for more deep dives and practical guides. If this video changed how you think about free trading, share it and keep looking beneath the surface. Credits roll over a recap of key takeaways presented visually in quick, digestible bullet points for viewer retention. You should remember the essentials. PFO exists, it creates conflicts, and your execution matters more than commissions alone. This concise summary will help you act quickly the next time you trade and teach others what to look out for. The final image lingers on the crossed-out free sign to remind you that transparency is the real value to demand.